My name is Andrew Stotson. I want to welcome you to the Valuation Masterclass Bootcamp final presentation, and it's really getting exciting. The presentations are great. We're getting excellent questions, and I want to welcome you to ask any questions that you may have. These are some of the biggest companies in the world that the students are trying to value. It's not easy to value these companies. They're complex. There's a lot going on. And they've only been working on these companies for the last 5 weeks, because the first week of the boot camp, they're working on the industry, not the company. So really impressed with what they're doing. And I want to bring up our next guest, our next student and attendee. And this is Ayush Mita, who we call her AG. And let's bring her on. Hold on. How are you?
I'm good. How are you doing?
I'm good. I like that picture that we just put up of you because it looks so relaxed. So I'm hoping that you feel relaxed now,
A little nervous also.
of course, but you're going to feel really, really relaxed in, very short amount of time. So you ready to go?
Yeah, sure.
Okay. So I'm going to bring up your presentation right now. And um, before we get started, you got nice, some nice cheering on here. So all the best, as you see. So I'm ready. Are you ready?
Ready.
I'm going to take myself out of the presentation, so it's all up to you. As soon as I disappear, which I will in a minute, in a second, take it away. So I'm going to go out now, and you go.
Hello, everyone. This is my coverage on BP, and I've come up with a buy recommendation based on a target price of $6.5, implying a 9% upside from the current price of $5.9. Now, I have derived my target price using a relative valuation of PB to ROE ratio by re-rating PB to the UK sector PB and ROE ratio of 1.5x for 2024. Now, the main highlights for the company is that BP is making a big bet on green energy, which could potentially make it a market leader. They're also making strategic offshore investments. This is a segment that they hadn't tapped into before. The main risks are volatile energy prices, and not only the future of BP, but the future of the entire oil and gas industry depends on these volatile energy prices. Now, let me tell you a little about the company. BP, which is British Petroleum Company, became one of the world's largest oil and gas companies through the merger with Amoco Corporation of the United States in 1998. BP is one of the top 5 oil and gas companies worldwide in terms of market share, and it operates in more than 60 countries around the world. Its key products and services include crude oil, natural gas, refined petroleum products, and renewable energy solutions such as wind and solar energy. BP owns renowned companies like Castrol, Aral, Arco, and AMPM. Now let's move on to my stories of how BP is fueling the future with both renewables and oil. As I said, BP is putting on a big bet on green energy. It plans to invest over $60 billion by 2030 to achieve 50 gigawatts of green energy capacity. BP plans to invest 16 to 18 billion annually on both solar and wind projects. It aims to use these renewable energy investments to boost its bioenergy, EV charging, and hydrogen business. Now, BP plans to derive 20% of its EBITDA from renewable energy by 2030, which I think seems highly ambitious because currently it only derives 5% of its EBITDA. This big bet could potentially strain the financial position of BP in short run, but if successful, it will position BP as a market leader in the renewable energy sector. My second story is that strategic offshore investments signal strong growth prospects. BP has been making significant investments in the Caspian Sea as well as in the Gulf of Mexico to increase their production capacity by 50%. Offshore investments is something that they hadn't tapped before because it wasn't possible to go into the sea. But now they're bringing in technologies, and I think these investments will significantly increase their production capacity. And I predict a revenue growth of 2% by 2026. My third story is that BP's green pivot may boost revenue, but it will shrink margins slightly. Now, as BP is trying to invest in renewable energies and low carbon energies, there are two things that I think will happen as a result. First is that these require a lot of investments and they have longer payback periods. And the second is that the margin which comes from these renewable resources is around 6 to 8%, in contrast to the 10 to 15% return which comes from a typical oil and gas project. So I think that even though revenue is going to increase, the margins will be lower to around 15% as opposed to the current 20% net margin. Now, BP belongs to the oil and gas sector, which belongs to the energy industry. Oil and gas remains the world's leading fuel, accounting to nearly 55% of the global energy consumption. The oil and gas sector is an oligopolistic market, with Saudi Aramco holding 55% of the market share, as you can see in the first diagram. BP holds a 4% share in the industry. Now, as population is growing, the demand for energy will be on the rise. While European companies push for renewable energies, many developing nations like Africa still lack access to necessities like clean energy and cooking fuel, and so the demand for oil and gas will continue. As you can see in the second diagram, the demand for energy in Europe and America has been stagnant but has been significantly rising in Asia. And as the population of India and China will be on the rise, the global energy consumption will increase overall. Now, the use of oil will remain very essential for the industrial processes and heavy duty transport, such as shipping, trucking, and aviation. Even though companies have said that they want to increase their gas and renewable resources to 20%, the truth is that companies still invest only 2.5% of their capital on clean energy technologies like renewables and EV. So the dominance of oil and gas industry will always continue over renewables for a long period of time. So the oil and gas industry will continue to grow. Now let's look at the financials of BP. These are the quarterly reports. As you can see, the revenue has gone down from the last quarter of 2023 to the first quarter of 2024 by 13%. And similarly, the gross profit has gone down by 38%. Now, the two main reasons for this downfall is first because of the volatile energy prices, and second because of an oil spill in one of the US refineries, which decreased their production capacity by 2%. Now, let's look at the consensus estimates. According to the current consensus estimates, out of 23 analysts, 8 have recommended a buy and 7 have recommended a hold. Their mean target price is 7.83, which is a 32% upside from the current price. Let's look at the revenue structure of BP. According to segments, customers and products brings 67% of their revenue. Gas and low carbon energy brings 21%. But surprisingly, low carbon energy is only 5% from the entire oil and gas revenue segment. Oil production and operation brings in 10% of their revenue. Geographically speaking, 60 to 65% of their revenue comes from the United States as well as the United Kingdom, and the rest 35% comes from Asia, Africa, and the rest of the world. In the revenue diagram, you can see that the revenue is constant, but their net margins are set to fall. Let's look at the benchmarking of BP against 450 non-financial companies in the United Kingdom. As you can see, overall, it's ranked below average. Looking at the fundamentals are also below average, particularly because of their falling operating profit margin. The valuation is in the top 30% because of their low price to sales and price to book value ratios. Momentum is almost worst, especially because of their falling operating margins and falling change in price. The risk is also below average, especially because of their stable current ratios and falling net debt to equity over the years. Let's look at PP's benchmarking against 320 large energy companies worldwide. If you look at the profitability growth, it's ranked 7, which means it's in the bottom 40% of the companies. When you look at profitability, it's ranked 6, which means there is room for improvement in profitability. For growth, you can see that their rank went up from 9 to 3, but it fell again to 8, which shows poor growth. Let's look at the profit and loss statement. I have forecasted revenue to fall for the first 2 years, but then increase slightly as their investments in renewable energy and offshores will start bringing in revenue. Net profit margins are also supposed to fall, which is in line with my stories of how their margins will decrease over the years. Looking at the balance sheet, their long-term investments is rising. When we look at the liabilities and equities, their long-term debt is also rising as they hope to finance their huge capex by long-term debt over the years. When we look at price to book value per share, it's actually quite good as it's increasing over the years. Looking at the cash flow statement, capital expenditure is increasing significantly. As I said, that they have planned to spend 14 to 16 billion over the years. Ending cash flow is positive, which is a good sign for the company. Let's come to the ratios. They have a stable current ratio over the years. Gross profit margin and EBIT margins are falling. When we look at the second page, the return on equity is falling, but an 18% return on equity is quite good for a mature company in this energy industry. Looking at the free cash flow data, I've estimated a 39% tax rate. Depreciation is also rising in line with the rise in capex. The free cash flow per share has been at a constant 1.6, which is a good sign for the company. Now let's come to my valuation and target price. As I said, I have used a PB to ROE ratio to value my company. In the diagram, PB to ROE ratio for 2024 for BP is 0.07 times, which is trading at a significant discount compared to the energy sectors in the UK, world, and Asia. Looking at the historical ROE, I expect BP's ROE to be 18.5, which is quite higher than the UK, Asia, and globally. I think a re-rating to the sector PB to ROE would make sense because I don't see any reason for BP to trade at such a discount to their sector. I'm giving a re-rating to BP with 1.5 times, which brings my target price to $6.5 per share. If we look at the relative valuation based on PE ratio, the PE ratio is also quite low as compared to the other sectors globally. EPS growth has actually been negative for all the other sectors except BP, which potentially shows that BP is trading at a discount to its peers, and this could present a good value opportunities for investors at the moment. Let's look at the absolute valuation. I have used a cost of equity of 12.1%, a company beta of 1.3, a weighted average cost of capital of 9.1, and a terminal growth rate of 1%. Using these values, I have got 2 through DDM, 18 through FCFF, and 18 through FCFE. I chose to not use the absolute valuation because of the significant upside that came. And I feel like at this moment, investors do not have that much confidence in the company to give such a high upside at this point in time. Let's look at the main risks for BP. Volatile energy prices. Now, BP's financial performance is very sensitive to fluctuations in oil and gas prices. Because even though the company is trying to invest in renewable energy, a significant portion of their revenue comes from fossil fuels. And volatility in energy prices could significantly affect their financial position. Second is stringent regulations. Over the years, the regulations on carbon emission have increased by a significant amount. If a company does not innovate effectively, it will lead to high operational costs and lower efficiencies over the years. So significant R&D is required constantly by BP. Now, while these problems are industry related, there are two risks which are specific to BP. Frequent accidents. Common accidents and oil spills pose a big risk for BP. BP has showed three accidents in 2023, which is actually a big thing in such an industry. So, operational errors and equipment failures could heighten the risk of future spills, which would lead to a severe financial loss, and it shows a negative market evaluation of the company. Second is supply chain disruptions. So, as BP is trying to shift to renewable energy fuels, its dependency on materials like lithium and rare earth elements is increasing. Any supply chain disruptions in these materials can impact their project timelines and their costs. So, even though the energy sector is at a volatile phase in their business cycle, I think BP is going to adapt and change in this energy landscape. And so, my recommendation is a buy. Thank you.
Excellent, excellent. All right, let's go through a couple questions. This is a good one. Consensus sees a 33% upside. You know, you had a big number on the free cash flow valuation.
Yeah.
And you got to, why are you so conservative on your upside?
Uh, it's mainly because of the fact that the bet they're making on renewable energy could go in two ways. It requires significant investment, but if the results don't show, I mean, they're all basically thinking that the demand for EVs and renewable energy will rise. But there is a strong chance that it won't rise. And that will become a waste of their investments. And also because the consensus thinks that the net margins, they have actually assumed a net margin of 18%, but I feel like as they're changing their business model to and to oil and gas products instead of just oil production, their margins are supposed to fall because it's only about the top line now.
And I'm just curious, you know, I look at the company and I think it's taking some pretty risky bets. Would BP be considered the company that is the most aggressive of the majors at taking on the transition?
I think so because at this point, BP does not have a very big market share. So it's really trying, it's taking a bet because it knows it doesn't have much to lose. So I think it's a good decision. And they're also shifting from oil production to customers and products, which I think is a very good shift.
And what's the risk that this shift is really driven by government regulation, not by
Yeah.
consumer demand?
No. It's basically government regulations and the prices, the volatile energy prices.
Um, Another question comes in. Could you please explain the reason for high capex assumptions?
Yeah, as I said, as my story suggests, let me go to my stories page for a second. Uh, yeah, so as you can see here, that BP has actually said that they want to spend at least 16 to 18 billion annually. And looking at their quarterly reports, half a year is over and they've already spent half of it. So I think they're going to continue spending that. So that is why I've taken that forecast.
And Moman has a question. Why do you think so strongly think that they'll be able to capitalize on this energy shift?
I actually don't strongly think that. I think it's a big bet, which is why I've called it a big bet. I think that if it does turn out, they would become a market leader in the renewable sector because it's not a saturated market. So there's a lot of potential in the renewable energy sector. So even if they can do a little bit, I think that would bring a big change in the industry.
So how does it feel to graduate from the Valuation Masterclass boot camp?
It feels great. I mean, I finally feel like I can rest for a bit now. This last 5 weeks have been very hectic.
Extremely hectic. And
Yeah.
I noticed that you had a really controlled pace, steady, whereas some of the other presenters tried to go really fast to cover a lot of things. What was your strategy there?
Um, and nothing much. I think ever since I started practicing since morning. I woke up and I kept practicing. I timed it because I actually wanted it to be perfect.
Yeah, it was great. Tell us about the transformation that you went through. What were you like before you attended compared to where you're at now?
Oh, I actually remember when you told us to come up with stories, and I just came up with some story, and I didn't know how important it was. But once we started doing the valuation, I realized that, oh my God, these stories are what bases everything. So then I started reading about the company, about the annual report, and what story could actually make a significant difference. So, I mean, I didn't understand, like everybody says that every story has a number and every number has a story, but I think I learned that practically with you here.
That's a great lesson to learn. Well, congratulations, and it was great presentation. I enjoyed it, and now it's time to rest a little bit. I'm going to take you out of here, and then we'll have our final presentation for the night. Woo woo!
Thank you. Thank
All
you.
right, see you soon. So that was a great one. You may know if you've been watching all the different ones that she took it slow, really measured, and I like that. It was more helpful for me to understand it. So that was great. And if you want to build a competitive advantage in company valuation, why not join the Valuation Masterclass Bootcamp? This is a place to make it happen. You can see the transformations that our students go through from zero to hero. So I challenge you, go to valuationmasterclass.com/bootcamp